Bitcoin is dumping and the timelines are in absolute panic. But let's get one thing straight here, guys. This is just a correction, and the crypto cycle is far from over. If you sell your tokens on every sharp drawdown the market gives us, you miss some of the biggest opportunities to profit and some of the biggest moves throughout the entire cycle. So the question isn't, is the cycle over? The question should be, is the structure broken? So we're asking ourselves, is the structure truly broken? Well, let's take a look at the Bitcoin chart. This is the weekly, and here we see a few things. One is we failed to punch through the bearish fair value gap we highlighted last week. And two, price is beginning to sell off after the last 4 to 5 months of over 50% gains. So when you see timelines on Twitter, on Instagram, and from your favorite influencers that are promoting crypto coins saying this cycle is over, zoom out and put things into perspective. Bitcoin ran over 50% this year alone. And what we're experiencing is just a minor pullback. Remember, guys, in crypto and high beta assets, 20, 30, 40% pullbacks are normal. So here is where most traders slip. Most traders watch price, but fail to watch pressure. When ETF demand and the underlying credit structure of the market diverge, price lags and then flips. So stay with me here, because what we'll look at is what affects ETF flows while breaking down how I measure institutional grade credit mapping of the Bitcoin ecosystem. Because institutions control ETF flows, we need to understand what controls institutions. And that overarching hand that controls them is liquidity. Now, earlier this week and last week, we saw a major liquidity drain in the market from the TGA, the Treasury General Account, so the checking account of the US government, fill at a rapid pace. It's sitting upwards of $500 billion right now. So that's $500 billion that have been taken out of capital markets that is now sitting in the US government's checking account. This in turn has negative price impact on assets, especially risk assets, because risk assets are very sensitive to liquidity. So when liquidity exits the system, institutions flinch, then the ETF demand dries up, Bitcoin's price wobbles. Now, there's a plethora of ways to measure liquidity. There's more complex ways, there's more simple ways. And me personally, I like to keep it simple. And one of the easiest ways to do that is to watch the DXY, which is the US dollar index. And the US dollar index is a very good proxy for liquidity conditions around the world. When we have a strong US dollar, more money is going towards paying yields, and that money is being stripped away from risk assets. When we have a weaker dollar, people flee a currency that is losing value. Less money is going to pay yields. People will seek yield farther down the risk curve. And we can see the DXY just had a pop this week. Could be another factor that is driving this Bitcoin dip. Now, when it comes to the underlying structure of the Bitcoin ecosystem, I haven't really heard of many models or tools available for traders to map the integrity and stability of a credit ecosystem, especially in crypto, perhaps because of its immature market status, and perhaps a lot of these cryptos aren't quality collateral. However, as the world begins to capitulate more into Bitcoin, I believe the next few charts I'm about to show you and the next few models I'm about to show you are going to be super important for traders and investors in the near future that are looking to not only get into Bitcoin, but use leverage and establish credit on top of it. So what on earth could I possibly be talking about? Well, my friends, this was a spin-off from one of my overarching theses around Bitcoin. What we're looking at here is what I call the Bitcoin gravity well, and it measures how far Bitcoin is being pulled down to base layers in financial systems and used as collateral. And what the gravity well model allows us to do is map this transition and then categorize specific market credit regimes so we can get a better understanding of structural integrity of the Bitcoin ecosystem. And we do this by using two metrics, the Bitcoin collateralization rate and then collateral velocity. And so with these two metrics, like I said, we can categorize the market regimes into 4 different categories. And the one we're currently sitting in is high CV, but low BCR. So not a whole lot of Bitcoin is being used as collateral, but that collateral has high velocity through the system. So what that tells us is that leverage is present, however, it is unsustainable. Which is why we have pumps that turn into relatively sharp corrections. Now, as we see BCR climb in the 2.5–3%, we will see more sustained rallies with lower volatility and easier corrections. So, if we take into consideration the liquidity conditions right now and the readings from the Bitcoin gravity well, we can come to the conclusion that A, liquidity is still on the rise despite short-term drains from the TGA and DXY spikes. Why is liquidity on the rise? Due to fiscal dominance, treasury buybacks, and other factors like that. And B, from our gravity well reading, the overall market structure is broken down into leveraged rallies that aren't very sustainable and often lead to sharper corrections. However, this will change as BCR increases, as more Bitcoin is used as collateral. Rallies will become less leveraged, drawdowns will become less sharp, and the general market trend will begin to smooth. However, moving forward, we need to keep an eye on liquidity. In the short term, yes. We need to understand general market structure favors leverage right now. The best thing we can do, if we're not traders, is buy spot and turn off our phone. The cycle is not done. Corrections are healthy. In fact, due to these rallies relying on leverage, they are needed. A clean reset is needed before we see the next leg up. If you guys enjoyed this video, drop a comment down below, leave a like, always hit that subscribe button. I'll catch you guys in the next one.